Ladies and gentlemen, my name is Greg Michalowski. I'm with ForexLive.com, and this is the weekend version of my technical analysis, but I always like to talk a little bit about my thoughts about the economy and so on and so forth. We had a great jobs report on Friday, so can't keep my mouth shut. All I can say is, wow, the jobs report on Friday came in much better than expected. 528,000 jobs versus 250 expected. We saw manufacturing payrolls rise by 30,000, government jobs rising by 57,000, leisure and hospitality soared. We saw unemployment rate come down to 3.5% from 3.6% expected and 3.6% last month. We also saw average hourly earnings increase by 0.5% versus 0.3%. Prior month was also revised higher to 0.4% from 0.3%. We saw the average work week tick up to 34.6% or 34.6 hours, and we saw the average hourly earnings year on year move up to 5.2% from with expectations of 4.9%. So strong. And that's something that the Federal Reserve was talking about, or some of the Fed officials were talking about last week, saying that they're not seeing any dip in the employment situation, and businesses are expressing that confidence to the Fed officials as well. And that, although employment is a lagging indicator, and we're seeing some ticks ups in initial claims and so on and so forth, we're not seeing it in the in these labor numbers, and so that's got to be a concern for the Fed officials, despite the fact that it is a lagging indicator. Because if people are working, they have the potential to spend, and the jobs report suggests that people are still hiring and there's plenty of jobs out there, and so as long as you're getting a paycheck, you can spend, or you have the opportunity to spend. You may have substitutions as far as food goes. The price of gas is now coming down, which is actually a stimulus now for the economy for these people who are working. And so my point is that we do get CPI coming out later this week on Wednesday, and the expectations are for a number of 0.2. That's nice. 0.2 times 12 is 2.4%. If we can average that, then we're back down toward the 2% target that the Fed hopes. But it's going to take a while because the rate is still at 9.1%. It's going to move down to something like 8.7% this week, or that's the hope. The core is still relatively high as well. So all these things have to still come down, and the Fed officials warn that inflation may be coming down because of the numbers are going to, big numbers are going to roll off. We're going to be maybe get some 0.2s, or maybe even unchanged numbers, or perhaps even negative numbers, depending upon if things like rent start to come down. A lot of ifs, ands, and buts, and all that other stuff that's going to go into what's going forward. But people are working and people could spend, so we could see inflation start to move back up again. And that's going to be a problem for the Fed. So with that in mind, you start to think about, okay, when things were really bad, what did the Fed do? They had no problem buying billions and billions and billions of bonds, right? So they ballooned the balance sheet up, and they've said that they're going to start to do quantitative tightening. With the jobs report moving the way it is and inflation still a concern from the Fed, I got to think they might start thinking towards doing more bond selling when the going is good. When the sun is shining, you make hay, and it's time to make hay. We see in governments that when good times happen and we have surpluses, we tend to spend, even keep the spending going. We don't save up for those rainy days. That's in the government sector, because government workers are voted on, and people love spending. But in the Fed's supposed to be independent. The Fed's supposed to be away from that sort of government and political influence. I wouldn't be surprised if we hear the Fed officials saying we need to do more bond selling. So be prepared for that. And that may be a shock for the markets. The Fed does not want to see, I don't think, the stock market erase all their gains and close higher in the Dow Industrial Average on Friday, after 528,000 jobs and the expectations of the Fed might raise rates by 75 basis points instead of 50 basis points. I don't think they want to see that. I don't think they want to see yields where they are in the U.S., where the 10-year yield is at 2.832%, when they want to move rates toward 3.4 at the end of the year. I don't think they want to see the market start to price in easing in 2023 just yet. So that's just that's my thinking. Don't be surprised if you start to hear Fed officials, including Fed Chair Powell, start to shift more toward that idea, because jobs are growing, grew at a fast pace, wages move higher, and if people are working and not getting laid off, they're going to continue to spend, and that's a problem with inflation. So anyway, that said, I thought we'd start to get in and take a look at the technicals, get away from that fundamental necessarily view, but look at the technicals. And I guess if the Fed is going to ratchet up, then you might have a bias more toward the higher dollar. But in my world, the technical world, the price action tells a story, okay? That story that I just told you is a story, but the price action in the charts help to tell the story as well. And I always rely on that, because that's the storytelling of the market. And the market is a collection of all the traders out there who buy and sell and decide the price, which is the most transparent thing that we could ever trade on. So taking a look at the euro versus US dollar, this is a easy one to interpret. Why? Because we've been in this range now for, I think, 15 trading days, where the market's moved up and down and up and down and up and down and up and down and up and down, with 100 and 200 hour moving averages staying in the middle between the extremes up top near the 50%. That's of the move down from the June 27th high. And on the downside, we have lows in between this 1.0096 and 1.0121, this area through here. So lots of lows in between that area, lots of highs. Maybe go from here to here. On the top side, in between, we have the 100 and 200 hour moving averages. And in trading last week, we saw the price move above and below the 100 and 200 hour moving average. And it actually worked, fairly consistently, that when the price fell below the 100 and 200, the market moved more to the downside, came up, tested it, moved to the downside, tried to stay below this level. And then when things on Thursday, we moved above, we traded above, and then we tried to stay above until Friday. The jobs report sent the price to the downside. Note here that on the rebound to the upside on Friday, where did the sellers show up? Right against the 200 hour moving average. So sellers did their thing against that, kept the bias to the downside for the euro versus US dollar. A little stronger dollar in that respect versus that currency. But the pair still remains within a narrow, fairly trading range. And the story remains the same, that we either have to break to the upside and go lower dollar, or break to the downside and go higher dollar, or vice versa for the euro, weaker euro, higher euro. It seemed to me that the if this the fundamental storyline works out, then we're going to break eventually back to the downside for the euro. But we have to be in consideration as well, and this is where the the rub comes in, is that the euro's been trending to the downside all the way from way up here around the 123 level. So it's fallen about 24% from its highs, and that's a big move. Hence we have this consolidation at the lows. But and you never know, so you have to respect what's happening in the narrow trading rounds, the ups and downs. Take it for what it's worth, and look at the different clues in between to try to determine the shorter term bias for you as a trader. Okay, so the euro, get outside of the range, and we'll see what happens from there. Watch the 100 and 200 hour moving averages as barometers in the short term. Let's take a look at the dollar versus yen. And last week we saw the dollar versus yen on the daily chart move right down and test this blue line right here, which is my 100-day moving average. Okay, the 100-day moving average is a key longer term moving average. They talk about it in the news. That's why it's so important to market traders, is because it may even get a mention on CNBC. Okay, most of the time they talk about the story behind the moves. They don't talk about the technicals, but when something reaches a key moving average level, you might hear about it even on CNBC. So when was the last time the price traded below the 100-day moving average? You have to go all the way back to this point right here, which is in September 2021. So nearly almost a year ago that the price last traded below the 100-day moving average. We tested it here, we tested it here, we based off here and raced to the upside, and here we come down and retest it here in the trading this week and find support buyers against that level. I'm going to put a Fibonacci from our low to our high, and the 38.2 from the low of this base right here, where the price was testing the 100-day moving average, and the 38.2% retracement wasn't sniffed at 129.48 this week. So we're moving back away from it. The dollar's getting more strong versus the yen, and that seems to be right from a fundamental perspective. We do need to get above this swing low that we saw in July, toward the end of July at 135.55. We moved up toward that level and found willing sellers on Friday against that level. Looking at the hourly chart, risk this week would be the 200-hour moving average that comes in at 133.81. 133.81. Currently trading at 134.97. So there's 100 and so pips between this and this. But that ultimately, if we're taking a bigger picture view of the dollar versus yen, if the price is not able to get below the 200-hour moving average right here, then the buyers remain more in control. We did move up and broke above the 50% of this last leg to the downside, the corrective move to the downside, and we're trying to hold above that level. That would be really close support at 134.88 in the start of the new week. Another level or area would be in between 134.31 and 134.58. You can see we have a swing highs through here, swing lows here, then a swing high. We have a swing high, and then we broke above the level on Friday and stayed above that level right here, or the high of that level right here. So we based against that level. So this level might be a key intraday support or close support level as well. So support. Start to break through each of those levels. Takes a little bit away from the bullishness, but ultimately I think keeps the buyers in play as long as the price remains above the 200-hour moving average. Let's move on to the sterling versus US dollar. This is a look at the daily chart, and like all the other currency pairs versus the US dollar, the trend has been to the downside, especially things like European currencies. So we had the move down in the middle of July, and we have been building to the upside. We did reach a high 1, 2, 3, 4, 5 this week at 122.929. That occurred on Monday, and we started to see rotation back to the downside through the rest of the week. Going back to the daily chart, the move to the upside did break above the 50% of this last leg to the downside, but it's only of this last leg to the downside. If I were to move it to this high right here, we fell short of the 38.2 of this move to the downside. If we moved up here, we're still well short of the 38.2. So these are like the easiest of targets to get to and through, and it did for 1, 2 parts of 3 days before moving back to the downside. Notice if I were to zoom in here, how the price did find resistant sellers against 50% on Wednesday and Thursday before moving to the downside on Friday off the jobs report. So anyway, the bias off the hourly chart saw some tries above the 100-hour moving average here and here on Wednesday and Thursday. Each of those moves failed, and then we started to see more sellers. The lucky sellers against the 200-hour moving average before the jobs report were rewarded with a big, huge move to the downside. Of course, risk was increased during that time. We did come down to a swing area here where the market did find some support buying just below the 50% of this move to the upside. That comes also against the natural support at the 120 level. So understand that in the new trading week, if we move lower, we have to get below the 120 level, below the swing area, to increase the bearish bias. On the top side, I like the fact that the market on the rebound on Friday did stall within this area, swing high, right through here. Then we moved above and came down to a swing low through here, broke below here on this day right here. This was the end of month volatility, so I sort of throw that out, if I will. And then in trading this past week, we came down to support near near this old swing low, fell below, came down, tested this support level on Thursday, and then broke below, came up into this resistance area here, these swing areas. So watch this area. This is a short-term barometer for the new trading week, up to 120, well, let's call it 121. So we got 121 on the top side, 120 on the downside. Those are our levels for the current week for the sterling versus US dollar. Take a look at the dollar versus Swiss. What I see off the daily chart here is tries to get back above the 100-day moving average here and here. In between, on Thursday, the market moved up to the 100-day moving average, found sellers against that level. So the dollar buying off the non-farm payroll pushed the price above that level, but we're closing below the 100-day moving average. It's still going to be a barometer in the new trading week. Move above it, it's more bullish, stay below. And, you know, you got to respect the bearishness or the bearish tilt below the 100-day moving average. This is what it looks like on the hourly chart, where on Thursday we found sellers against that level, moved lower. On Wednesday we moved above and tried to extend higher, moved into this swing area here. And on Friday we have to, respect that the price did find some sellers against this swing area. You can see the levels through here where we have swing highs and lows in between these 96.52 and 96.53 areas. A very narrow trading range, and the price moved down back below the 100-day moving average. Get above, it's more bullish. Get above this area, more bullish. Get above the 50% of this, move to the downside, more bullish. Then we start to move up toward this swing area where you can sort of see this is the extreme and this is the breaking below the extreme. So this area right here would be another key target if the dollar is going to get stronger and the dollar Swiss is going to get stronger. We need to move above that area as well. On the downside, if we can't get above the 100-day moving average, the converge 100 and 200-hour moving averages down here near 95.68 are going to be a key target on the downside for the dollar versus Swiss. Let's take a look at the dollar versus Canada. While the U.S. data was stronger on Friday, the Canadian jobs report came in weaker for the second consecutive month. Two declines in the jobs number of jobs added. That sent the dollar versus Canada to the upside, but just like the other currency pairs, price started to move back to the downside, move back toward this swing area. Goes back in time. You can see a number of different swing lows and highs in between these red numbers. If I were to put a Fibonacci on the hourly chart from our low to our high right here, the price still remained above the 38.2 of this move to the upside. So somewhere around the 129 level would be a level where we don't want to see the price move below that level, and it sort of corresponds with this these swing areas through here between 128.96 and 129.07. So in your trading book, earmark the 129 level as a key level for the dollar versus Canada this week. Stay above that level, and we could and we could see the further momentum to the upside for this currency pair. On the top side, the high price that we saw on Friday did stall against the 50% of the last move to the downside, or ahead of that. That comes in near the 130 level. So 129, 130 are the barometers or the extremes that we could look for in the new trading weeks. Trade below it, move back down toward our 100-hour moving average, trade above it, and it opens up the door for further upside in that currency pair. For the Aussie versus US dollar, we're seeing still some upside, lack of upside momentum here in the current week. On Monday, the price moved up to a new high, but found a new high on this corrective move to the upside, but found resistance sellers against the 38.2% retracement at 0.7055. Sellers leaned against that level. That level is a barometer for corrective moves. It's a minimum retracement level that I like to see the price move to and through if let's say the buyers on the corrective move are to be taken a little bit more seriously. Absent that, and they're really not taking control from that retracement perspective, okay? They may be taking control in the shorter term, in a shorter term view, and that you can see on things like the hourly chart where the price started to move. This is the corrective move to the upside where the price started to move above the 100 and 200 hour moving average. And that's good news. That's good news. But as you build and build and build, you then have to start to work at other things like the 38.2 on the daily chart, which is the bigger picture view. Taking a look at this hourly chart, we are seeing some choppy action around the 100 and 200 hour moving averages. Through here on Thursday and Friday, ahead of the jobs report, the market's unsure. Okay, it's waiting for the jobs report. I'm not surprised that that we saw price action trade above and below the 100, 200 hour moving average. But since that point, the jobs report, the market then fell sharply to the downside, held support near the 50% retracement of this move, of the corrective move to the upside. So we got to give the market some credit there for holding support against 50%. And the rebound, though, came into this swing area where we have, you know, a number of swing highs and lows that have, you know, had this area earmarked between the 69.11 and 69.19 level. So we did find some stall near that level, also stalled near the broken 38.2% retracement. So in the new trading week, you know, I would look for the 100 and 200 hour moving averages as topside resistance. If the dollar is going to go higher, it shouldn't move above those levels. Okay, we should find sellers against those levels on any move to the upside. If the price starts to move away from this area earlier in the week, then it could open up the door for continuation to the downside, or should, below the 50% retracement, and let's say below this level right here where we had swing highs. I'm sure if we go back in time, we can see other levels through here where the market did find some support or resistance. So getting below the 50% would open the door for further downside, keep the put the bears more in control for that currency here. Finally, we'll take a look at the New Zealand versus US dollar, and this, like the Aussie versus US dollar, is on a corrective move to the upside. The price did move above the 50% of this last leg to the downside. If you were to move this Fibonacci up to here, however, we're not anywhere near the 38.2% retracement of this move to the downside. So this is a modest, somewhat correction, like one of the other currency pairs I did earlier. This 50, 38, and 50% become the easy hurdles to get through, and then you start to rotate back up to here, and it becomes a little bit more difficult. But what you want to see is the price stay above the 50%. It couldn't do that this week, although, you know, 3 days above that level, or the price traded above that level, at least one close above that level, and then the price started to move lower. Notice on Thursday, the high price did stall ahead of the 50% retracement, so that gave traders a little bit of clue to the downside. If you take a look at this swing area right here, the market did come down to that level at the lows this week, where the price did hold support against this prior low, and these prior highs, and we moved back above that level. We started to reestablish support here at the 62.12 to 61.96 level. Move below that level, so let's say get below the 62 level and stay below that level. That increases the bearish bias for the New Zealand versus US dollar. Before I go, I want to bring up the importance of some of the stock charts going into the new week from a technical perspective, and this is off the daily charts of each. This is the Dow Industrial Average, and the Dow Industrial Average is closed just above its 100-day moving average after trading above and below it really every day this week. So the price is still unsure of what it wants to do. If we that 100-day moving average comes in at 32,711, and if the price should move away from that to the upside, we will look toward the 50%. If we move below that, watch a break of the 38.2% to increase the bearish bias. We sort of found support against that level on this dip on Tuesday's trade. The S&P index is also trading right around its 100-day moving average. We closed above it at 41.45 on Friday. So, but it's also near the 50% retracement of this move to the downside. So key barometers near the 41.37, 41.45 for the S&P I'm sorry, 41.17, 41.37, 100-day moving average, 50% retracement. Start to move below those levels, that would be more bearish. Stay above, it's more bullish. And finally, the Nasdaq Index did close higher last week, and it traded above and closed above its 100-day moving average, 1, 2, 3 trading days, but is having some consolidation problems around the 50% retracement of this same move to the downside. So that's going to be a key barometer. 12,606 is where that level comes in. The 100-day moving average moved back below that level at 12,330.81 area. Would be more bearish for the Nasdaq Index. So there you have it. A look at some of the currency markets. We'll talk about the fundamentals. We'll talk about the stock markets. My name is Greg Mikulowski. Wishing you all the best in your trading this coming week. Good fortune with your trading. Bye bye now.